Hi, everyone. This is Tim Melvin of the Deep Value Report, coming to you live from Central Florida once again. We're a little late with this, as you'll notice. We'll usually try to have this out a little earlier in the weekend. But my wife is away on a school field trip to DC with our youngest. So I took today to make the 2 hour drive over to Sarasota and spend a little time out in the sunshine watching the Orioles and the Pirates battle to a 7-7 tie. And then did a little touring around over the coast and headed back home. So this is a little later than usual this week. Very strong week for the stock market, up about 1.5% as the market was spooked earlier in the week by Janet Yellen's comments that she could begin raising interest rates as soon as 6 months after the end of taper. But we all decided that she was just a slip of the tongue and a rookie mistake, and probably really didn't mean it. And went ahead and started buying stocks again. So very good week for the major banks, as 29 of the 30 of them passed the major stress test that the Fed just conducted. We'll find out next week which banks will be allowed to go ahead with their plans to raise dividends, pay dividends, and buy back stocks. Some banks, Wells Fargo most notably, have argued a bit with the assumptions that the Fed made. They think that they're actually stronger than the stress test showed. We'll see how that plays out next week when we find out what they're allowed to do as far as dividends and buyback. It'll be very interesting. Anyway, during the week, I read a really well thought out study. Obviously, the author put a lot of thought into this. It was very rational sounding about the fact that stocks are expensive, that they should be. They should be because the returns from stocks and bonds are very, very low right now. So the expected returns from stocks, although better than the alternatives, is also going to be pretty low. So this level is okay and sustainable. It's just not going to give us very high returns. Also cites, of course, low interest rates and things like the declining supply of stocks that's actually out there. All of it makes sense. It's pretty well thought out. He really criticizes people that say, hey, on historic measures, this market's overvalued. Um, he goes on to say a large decline is unsustainable. And I certainly hope he's right about this. I don't want to see stocks fall 50% and stay down there forever. I'd love to see them fall 50% and then rebound. That'd be a party for me. But every time I see these reports, and I've seen them so many times over the last 28 years, arguing that this time's different and prior historical measures and valuations should not be used because they simply don't matter. That's just a huge red flag to me. Just think back over the years. We'll go all the way back to Irving Fisher, a guy that people like James Tobin and even Milton Friedman agreed were the greatest economists that America ever produced. 3 days before the crash of 1929, he told investors that the economic future was just so bright and conditions so good that stocks were now at a permanently high plateau and would not decline. John Maynard Keynes, we can argue about him, but he was a very smart guy and a great economist. And in 1920, by the way, also a very good investor once he stopped trading and turned to long-term management of his portfolio. In 1927, he told investors there were going to be no more crashes. The economic conditions as such did not support the potential of a stock market crash. Now, in the late 1990s, and I remember this like it was yesterday. I was a broker at the time, and we're turning out pretty decent long-term returns for clients, but 15 to 20% did not feed the bulldog back then, guys, because everybody's nephew was investing in internet stocks, and they were making 100, 200% a year, and everybody wanted in on that party. The internet was going to change the world. Technology was going to make our lives so much better and so much easier that the market had reached a new paradigm, and it was really different this time. Heard the same stuff in 2006 about the housing market, that things had changed and the housing market was going to go up forever because of this demographic reason and that economic reason. And then in 2007, we heard that these big banks couldn't fail. Lehman Brothers, nobody was going to allow them to go under. Same with Bear Stearns. It was different this time. There was sufficient liquidity. Well, no, there wasn't. Here's the truth of things. The internet really did change things and made all of our lives easier. If you look at the economic progress from the 1920s to today, once the Depression was over, it's been remarkable. It's been incredible. All those guys were right about what the future might hold, except for the guys who said housing could never go down. They just kind of got it wrong. But you could pay too high a price for anything. You could pay too high a price for any amount of potential. At certain levels, markets, like individual stocks, are at levels that simply aren't sustainable. I don't know if we're there yet. I think we're on the high side of fair. Some of the measures that you look out there, Warren Buffett said to like market cap to GDP, and I think that's a really good measure. I also like the Tobin Q ratio, and I'm a big fan of the value line median appreciation potential. All of those say that the market, we're at not at 1999 levels, but we're kind of close to 2007 levels. And while not egregiously, ridiculously overpriced, we are on the high side of fair. Now, my biggest indicator that I use is the number of cheap stocks that I can or cannot find. In 1999, there were none. They didn't exist. In 2006, 2007, I go back and look at my blog. I was, saying, hey, there's no stocks to buy out here. This market's crazy. Valuations are too stretched. Today, I wrote an article earlier this week, appeared on Real Money. We sat down with an 11,000 stock database and we screened it all the way down for stocks that were very cheap and very safe. The balance sheets were good, their financial conditions were improving, and they traded at significant discounts to book value. 11,000 stock database, 12 stocks fit that criteria right now. Now, caveat, that's outside the community banking area. I think that there are a lot of small community banks. They're very illiquid. They don't trade much. There are special circumstances in that industry that give you a chance to maybe get a little bit more involved with the market. But in a new money portfolio today, if you're focusing on community banks, probably come up with enough stocks to get 65% invested in that portion of the portfolio. But in the broader market, 25 to 30%, and that might be pushing. And that's using my usual 1 to 2, maybe 3% position size. So like Edward Schloss, I like to own a lot of cheap stocks, as many as I can find. If I can't find them, I hold cash. We're holding a lot of cash right now. I don't know about the new paradigm or why stocks should be expensive in a rational world. I don't understand any of that stuff. Never had terrible market timing by my own admission. What I do know is there's not a lot of cheap stocks. That is a caution flag and makes me want to be a little bit more careful. Now, somebody reminded me the other day, they're like, Tim, you sound so negative. And it's like, I'm not negative on the future of this country, guys. I am very well aware, like JP Morgan once said, anybody that bets against America is going to go broke. I don't want to bet against America or the future of our financial markets. I want to bet for them. I just want better odds and a better price on my bet, and I'm going to wait until I get it. And I think most investors should do so as well. Anyway, let me give you a book recommendation this week. Read a book, a guy named Dan Jenkins, former Sports Illustrated columnist, also has written for Golf Digest and did a lot of sports and golf stuff for Playboy magazine over the years as well. Best known, of course, for books like Semi-Tough, Unnecessary Roughness, Life Its Own Self, and a few other things. And these days, his biggest claim to fame might be the fact that he's Sally Jenkins of the Washington Post's father. But this is just an incredible book, guys. Examines his career all the way back. The days of playing golf with Ben Hogan in the 40s up through today. Incredible insights on the business of sports, the business of sports reporting, and just incredible anecdotes about college football and golf primarily, and other journalists that he's run across. Just one of the best reads of the year so far for me. If you're like me and you kind of wish that you'd been born long enough ago to be one of those guys that was, had the whiskey bottle in the drawer, his nicotine stained fingers on an old battered typewriter, turning out prose and painting pictures that would make Shakespeare blush and Damon Runyon, weep for joy, this is the book for you. Best read of the year so far in 2014 in any classification. Really suggest it if you're a sports fan of good writing, or just want to laugh out loud a few times. It's a pretty quick read. Highly recommend that book. Anyway, not a real busy week this week. We do get... Gotta love the government. We're going to get the third revision of the estimate of fourth quarter GDP. Came in very strong originally, was revised downward. Most folks now expect it to be raised upward a little bit this time. We'll see. And then at some point they'll revise this revision as well. In spite of that, the market will trade around that number. I guarantee it. If there's any significant deviation from what the analysts expect. We've got a couple of Fed governors that are unfortunately allowed out to speak at various events this week. That's always good for some laughs and some potential market moving statements. Um, the one that I think that potentially could be the most market moving is President Obama is going to the EU summit on the Ukrainian situation. That could get a little serious if we get any commentary out of there. They take really specific, strong actions, and the Russians respond in kind, and they will. Um, that could have serious economic consequences for the European region, and that would spill over into the U.S. economy and the U.S. markets. So, kind of watching that one closely, but I really kind of stick to my original thoughts that the West is overpowered, or they can make a lot of noise, but I don't think that they can risk doing much of anything. But we'll watch it anyway. Walgreens reports earnings this week. Don't expect anything significant there, nor do I expect them to pull a CVS and say that they too are pulling cigarettes out of their store. At least I hope not. That's where the cheapest cigarettes in my neighborhood are. So I hope they keep selling them. Anyway, Lululemon reports this week. We'll see exactly how the women's yoga outfit business is going. It's never understood this stock, but then again, I never really got yoga either. So we'll see how that plays out. It is a high multiple stock that's been a little rocky of late. And GameStop will be out and let us know how the brick and mortar video game business is going. If I was going to judge this by just my house, I would say it was pretty good. But they've struggled to make the numbers of late. We'll see how this all plays out and what kind of numbers they hit in the last quarter. So that's going to be the news for this week. We got the Dodgers and the Diamondbacks, of course, played the two first official games in Australia. A little strange way to kick things off in my mind. Dodgers, by the way, swept that series. But we get real baseball later this week. We get opening day on the 30th, I believe it is, next Sunday. That's really exciting. Looking forward to some regular season baseball. And we'll see how the week plays out. Anyway, my son just came in with my bag of Subway for dinner. Can't wait till the wife gets home next week. And this is Tim Melvin from the Tim Melvin Deep Value Report. And we'll talk to you guys next week.